Hello everybody, I'm here with Gary Reynolds to catch up on how things have been going in the markets and how the Courtiers Funds have been performing and responding to recent downturns and all the things causing that. Gary, let's jump straight into performance. What have you been seeing over the last week?
Well, since the new year, we've seen some of the big tech stocks come under a lot of pressure on their prices, which is what we talked about in the December Courtiers seminars, and they've dropped back quite significantly. In fact, if you look at things like the Nasdaq, which is really a collection of a lot of those tech stocks, it's off about 13.25% so far this year. Whereas you compare that with our growth fund, that's off about 2.25%. So we were right to position defensively. Notwithstanding, that if you have been brave enough to be in these big tech stocks for the last 10 years or so, that you've done quite well. But so that's what we've seen so far in January. And of course, we've seen interest rates go up at the long end, and inflation looks like it's going to be a bit more embedded than the Bank of England thought. So lots of things have started to worry the markets at the start of 2022.
Mm-hmm. The crisis in Ukraine, I know that's been quite high in the media and spooking the markets and the FTSE down and the likes. How has that had an impact on Courtiers Funds specifically, if at all?
Well, nothing directly. And when you've been in this job a long time, you begin to realise that conflicts are something that pop up every now and then. When the company was formed back in '82, we had the Falklands crisis, we've had two Gulf crises. There's been a lot of issues to overcome. Obviously, you've had the previous invasion of Sevastopol by on the eastern side of Ukraine by Russia, and this causes a lot of rumours and upset. And it always does, but there is always some conflict in the world somewhere and some geopolitical risk that's bothering people, and this is no different. If you want to make an estimate of where this is likely to end up, it's likely to end up with Russia not invading Ukraine, and there'll be a negotiated outcome, and that's probably what we expect, because that's best for all parties. But we might have to go through a bit of posturing before we get there.
Thanks, Gary. There's been predictions about a crash. Is this the beginning of that we're seeing at the moment, or are you expecting there might be an uptick on the horizon?
I think the market's predicted 50 of the last two crashes, Leo. When you do this job, you are always worried about a declining asset prices. It's the one thing. Every morning, my routine, I woke up quite early. I grabbed my iPad, which has full access to live Bloomberg. I go to markets and I look at the futures market, and I can see instantaneously what Japan's done last night, bearing in mind that I am an early riser, struggle to stay awake at night, but I wake up about 5:15 in the morning, and that's my first thing I do. And the reason I do it is because I need to know whether there's anything major happened, and it's gonna influence what happens during the day. The point I want to make is that fear of collapsing markets is a 24/7 preoccupation for anybody involved in investment management. But most of the time it doesn't happen. And there are stacks of very good articles and extremely bright managers that have been older than me and have been doing the job for a lot longer, that always say you can't afford to go to cash because you just never know whether something's going to go wrong. But you can position yourselves to try and defend off against what we would call the tail risks, the extreme risks that might affect the market. And generally, you are better off with stocks that have got decent balance sheets, good cash flows, and are not too overly priced. And what I mean by that is that their price as a multiple of their earnings isn't excessive. And if you do that, you've got some defensive qualities. And I know it's only a few weeks, just over 3 weeks since the start of January, but the figures I quoted earlier are evidence of positioning properly or positioning, let's say sensibly, to have our clients' longer term interests in mind. So you always, in summary, you're always worried about a crash. And there's an old expression in finance which says stock markets climb a wall of fear. In other words, they go up despite everybody's worries.
Gary, thank you. I know we recently launched a new online account platform with some significant upgrades in that, and clients can dig deeper into their investments and any questions that might arise from that. Their advisors are on hand to help. Apart from what we're in at the moment, is there any potential opportunities at the moment that you've got your sights on?
Oh, there's loads, Leo. There's loads of really good opportunities. There are a lot of stocks that are not overvalued. They're trading on sort of 11, 12, 13 times price earnings. There are some really good value Japanese stocks, and we've bought a few of those recently because the market just is not too expensive. And we've been trying to diversify away from the American market for the last 2 years. And you do get good opportunities out there. So this is not a doom and gloom market where you're paying through the nose for everything. It's quite the reverse. You've just got to be a bit more selective because there are huge differences. You know, there's a spread which is talked about, you know, the spread between the multiples of earnings you pay for a growth stock versus a value stock. And that spread has been up and around record levels for the past couple of years. You know, Cliff Asness, who's famously talks about value investing, has pointed this out a number of times. So what it means is you've got some good opportunities out there, but you've got to dig. You've got to dig, and you've got to find them. And you mustn't get sucked in with the crowd. You're anybody watching this who does their own thing. This is a time for doing your research properly, because just piling into the big growth stocks or piling into cryptocurrency has massive dangers with it at the moment, and you've got to be very, very careful if that's a policy you're going at as an investor. Needless to say, we are not.
Gary, you mentioned Japan, thinking further around the globe. Are there any areas that we've not been invested in that you might be looking to invest in? South Korea, for example, they've reported quite an increase in their GDP at a high in 11 years, I think it is.
Yeah, there are lots of good opportunities around the world. So when you look at the metrics we look at, we start with countries, then into sectors, then into individual stocks. And we have been underweight emerging markets for quite some time, and we've been trying to change that recently. So although we've been building China, we've also looked to build up a few positions elsewhere. So we hold Samsung, which is obviously a one of the huge South Korean company. We bought a couple of Brazilian stocks recently. You have to be careful because you know some of the stocks that dominate in emerging markets are very heavily state controlled, like Petrobras in Brazil. So you do have to be judicious with what you choose. But we are actively looking to increase our emerging market exposure. And the other thing we're mindful of is increasing exposure wherever we can with companies that are likely to benefit from a move to cleaner energy. And that move is definitely underway now. The way in which markets and analysts are concentrating on ESG, environment, societal and governance, with the big emphasis on the environment to try and get to zero carbon emissions within a decade or two. You don't want to be it's a dangerous bet to be in a polluter now, unless that polluter is really trying to change its ways. But you really want to be in the businesses that are going to benefit from a complete rebuild of the global energy structure, from a carbon polluting structure to a carbon neutral clean structure, which I think is so exciting, because children and grandchildren are going to benefit from this down down the line. But you want the businesses that are going with that flow, because it's not going to change now.
How's it all going in that?
The world is genuinely committing. No, sorry, Leo. I was just saying the world is genuinely committing to sustainability. You're going to get some pushback from countries that are very, very heavily reliant on fossil fuels, Russia being one of them. But the developed countries of the West, and even China, I know it's been building a lot of coal-fired power stations, but it's in its interest to get over onto green energy as well. So, you know, you want to own companies that will benefit from that trend and not those that are going against the trend.
Thanks, Gary. I was going to ask, how's it been going in that area since Katie gave us some insight at the seminars back in December?
It's an exciting area, Leo. The guys on team are very interested in it. You know, they should be. They're a lot younger than me, so you know they are more incentivized to make sure we clean up our planet more than I am. So I think that's quite nice. You've got bright youngsters on our team, Katie being one of them, who have got a genuine interest in this subject, and it's influencing the way in which we think, and that's a good thing. I think it's very, very good for returns. So this is exciting, and we've got one or two developments coming down the pipeline in this area, which are still, you know, very much in their fledgling stage. But I think our offerings in this area are going to develop in the next year or so, and that's an exciting prospect. Certainly excites the team, and it excites me too.
Good to hear. Gary, and quickly to close, general view of performance throughout 2022 so far in the Courtiers Funds?
Well, yeah, we report on the relative performance. There's a schedule goes through every day, which Sam on our team issues to everybody. And our cautious, balanced and growth funds are top quartile over 1 month, 3 months, 6 months, 1 year, 2 years, 3 years, 5 years and 10 years. Now, it doesn't get much better than that. That is Happy New Year. So I'm really, really pleased with that, particularly because at certain times last autumn, investors would have been forgiven for wondering, were they missing out by being in Courtiers Funds and not being loaded to the gills with high-priced tech stocks? But that's all changed, and you know, our policy to keep the interest rate risk out of the portfolios, and our policy of trying to be in companies that could cope with inflation a bit better and were on reasonable metrics has really paid off. So needless to say, Leo, I'm delighted with those sets of figures, and we do our level best to maintain those through the rest of 2022.
Thank you, Gary. We'll leave it there. To the audience, viewers, if you have any questions, please do let us know, and we'll do what we can to get those across to the appropriate people. I know we've got a bank of questions sent through the client seminar, which are due for publishing very soon. We've got the answers together for those, so keep an eye out for those. We'll be issuing them shortly. Until then, thanks for watching, and I will see you again soon.